Understanding the Ponzi scheme. A Ponzi scheme is one of the most notorious types of financial fraud. It tricks people into investing by promising unusually high and consistent returns, often with little to no risk. At first glance, it looks like a legitimate investment opportunity, but beneath the surface, it's a house of cards that relies on a constant flow of new money to keep going. The term comes from Charles Ponzi, an Italian immigrant who became infamous in the United States during the 1920s. He promised investors a 50% return in just 45 days by supposedly profiting from buying and selling international postal coupons. For a while, he paid those returns, but not from real profits. Instead, he used the money from new investors to pay earlier ones. Eventually, when he couldn't attract enough new investors to cover withdrawals, the entire scheme collapsed. Since then, Ponzi scheme has become the general term for any investment fraud that pays old investors with money from new ones, rather than from actual profits. Key ingredients of a Ponzi scheme. The promise of high, steady returns. At the heart of every Ponzi scheme is the promise of unusually high returns that seem too good to be true, and often are. Real investments fluctuate. The stock market goes up and down, and even the safest bonds have limited returns. When someone offers consistently high profits, like 10% every month regardless of market conditions, it's a red flag. Ponzi operators use this promise to attract people who want quick, easy wealth. These unrealistic returns often make investors overlook basic due diligence. Lack of a legitimate business model. A real investment generates profit by producing goods, offering services, or investing in legitimate markets. A Ponzi scheme typically has no such source of income. The operator may claim to invest in foreign currency, real estate, or technology startups, but there's little or no actual investment happening. In many cases, there might be some legitimate activity, but the bulk of the returns come from incoming investor money. Without continuous recruitment of new investors, the scheme has no fuel. The cycle of paying old investors. Ponzi schemes survive by maintaining the illusion of success. When early investors see that they're getting paid on time, they trust the scheme and often invest more. They also encourage friends and family to join. What they don't realize is that the payouts they're receiving aren't from profits. They're just money taken from the newest investors. This cycle keeps going as long as more people keep joining and more money keeps coming in. This pattern creates a dangerous illusion. Early participants often appear to be making real profits, and may even defend the scheme to skeptics. In reality, everyone's money is at risk because there's no sustainable income source. The inevitable collapse. Every Ponzi scheme eventually collapses. Why? Because the operator eventually runs out of new investors. As soon as the inflow of money slows down, there isn't enough cash to pay the promised returns to earlier investors. Sometimes, the collapse is triggered by a sudden surge of withdrawal requests, such as during an economic downturn. At other times, regulators or whistleblowers expose the fraud. Either way, the result is the same. The scheme implodes, and most investors lose their money. The larger the Ponzi scheme, the more catastrophic the collapse. When Bernie Madoff's multi-decade Ponzi scheme unraveled in 2008, it wiped out about $65 billion in claimed wealth, ruining thousands of investors. Step-by-step breakdown of how it works. Let's break it down in a simple, relatable way. The pitch. The fraudster pitches an investment opportunity with high returns, say 15% per quarter, with no risk. Early investors buy in. Some people decide to invest. The operator takes their money, but doesn't actually invest it. Early payouts create trust. When early investors request withdrawals, the operator pays them using money from new investors. These payouts convince people the investment is real. Word spreads. Satisfied investors tell their friends and family, drawing in even more money. The scheme expands. As long as more new money comes in than goes out in withdrawals, the scheme thrives. The crack appears. Eventually, fewer new investors join, or too many existing investors demand their money back. Collapse. The operator can no longer meet the promised returns. The scheme unravels, and most participants lose their money. This chain reaction demonstrates that Ponzi schemes are fundamentally unstable. They need a constant supply of new investors to survive. Why Ponzi schemes are so convincing. You might wonder why people still fall for Ponzi schemes despite so many famous cases. There are a few key psychological factors: greed and hope. The promise of fast, easy money is hard to resist, especially in uncertain economic times.
Trust in reputation. Some fraudsters use their social status, religious communities, or professional credibility to appear trustworthy. Bernie Madoff, for example, was once a respected Wall Street figure. Social proof. Seeing friends or family members make money from the scheme creates a false sense of security. Consistency. Bias. Regular payouts, even for a few months, convince people the system is real, making them invest more. These human tendencies are what fraudsters exploit. Understanding them can help people stay vigilant. Notable Ponzi schemes in history. Charles Ponzi, 1920s. The original Ponzi promised massive returns from trading postal coupons. The scheme collapsed after just a few months, costing investors about $20 million, an enormous sum at the time. Bernie Madoff, 1980s to 2008. Madoff's scheme is the largest in history. Over decades, he lured wealthy individuals, charities, and institutions by promising steady returns. The 2008 financial crisis exposed the fraud when too many investors tried to withdraw their funds at once. Alan Stanford, 2000s. Stanford ran a $7 billion Ponzi scheme through fraudulent certificates of deposit in his bank. He used investor funds to finance a lavish lifestyle of yachts, private jets, and sports sponsorships. BitConnect, 2016 to 2018. In the age of cryptocurrency, BitConnect promised massive daily returns through a trading bot. In reality, it was just another Ponzi scheme that collapsed when regulators intervened, causing massive losses for investors. How to spot a Ponzi scheme. Recognizing the warning signs is key to protecting yourself. Unrealistic returns. If someone promises high returns with little or no risk, be skeptical. Steady returns. Regardless of market conditions, legitimate investments go up and down. Fraudsters often promise fixed rates. Lack of transparency. If you can't clearly understand how the investment makes money, it's a red flag. Pressure to recruit others. Some schemes rely heavily on bringing in new investors to sustain themselves. Difficulty withdrawing funds. Delays or excuses when you try to take out your money are a major warning sign. The impact of Ponzi schemes. Ponzi schemes don't just harm individual investors, they can devastate entire communities. Families lose life savings, retirees are left without security, and charities can be wiped out overnight. On a larger scale, major Ponzi schemes can shake public trust in financial institutions. After the Madoff scandal, for example, many people became more cautious about investing, and regulators tightened their oversight. How to protect yourself: do your research. Before investing, research the company, its leadership, and how it generates returns. Check with regulators. In many countries, you can verify whether an investment firm is registered with financial authorities. Be skeptical of secrecy. Legitimate businesses are transparent about their operations. Diversify your investments. Never put all your money in one place. Diversification reduces risk. Seek independent advice. Consult a licensed financial advisor before committing to any high-return opportunity.